If you were here a couple years ago, you may remember that I introduced you to Warren Buffett. I held up a popsicle stick with his face on it. This year, I'd like to introduce you to a less well-known but equally smart individual, and his name is Charlie Munger, and he's the vice chairman of Berkshire Hathaway. And last year, he held a meeting where people came up to him and asked him, Charlie, how do you find investments? What's the secret? His answer was, fish where the fish are. Right? So, to us, that makes a lot of sense. When we fish for investments, we look for companies that have growing profits, that have a track record of proven results. And to us, when Charlie said fish where the fish are, he's really talking about stick with good quality companies. When we look for investments, we do our research. We just don't go fishing anywhere, and that's the point of this one. So you've heard us say many, many times before, in the short term, the stock market's going to go up or down with the worries of the day. But in the long term, eventually stock prices will follow earnings, right? And here's a chart of the S&P 500 going back to 1965. Wow. So many, many years. And you can see that the blue line is the S&P 500. The red line is the earnings of the companies that make up the index, the S&P 500 index. A lot of stuff can happen over that many, many years, but if the earnings keep on growing, stock prices keep on following. So let's go fishing, guys. A fisherman's job is very simple. Pick out the best parts. And for us, in our opinion, the most successful businesses in the world are those that are asset light. An asset light business is a business that doesn't require a significant amount of ongoing capital to produce a product or service. I'm showing you an example of an asset heavy company. This is ExxonMobil. You may know Exxon is one of the world's largest oil and gas producers. Exxon has to spend billions of dollars each year exploring for oil, drilling for oil, refining the oil, just to make the dollar. And they have to keep on doing it year in and year out, no matter what the price of oil is. Exxon is an example of what we call a price taker. It can do everything right. It can keep its costs low. It can hit jackpot and find lots of oil. But you know what? If the price of oil keeps on falling, Exxon has no control over that. And you can see over the last 10 years, here's Exxon's stock price. It's done nothing. And we've had one of the best bull markets in the U.S. Going back since the S&P 500 started. So we try to invest your money in companies that are price makers. And the evidence is clear. Here's a chart showing companies, the capital-intensive companies, there's a dark blue line, versus non-capital-intensive companies, or those price maker companies, asset-light companies. And you can see that going back, 30 years, non-capital-intensive, asset-light companies have outperformed. The choice is clear. So now we know what fish we want to catch. Where do we go and catch them? The answer is the United States. For the most part, the best fish have been found in the U.S. What you're looking at is the performance of the U.S. index versus the world index. And you can see that over the last year, 3 years, 5 years, 10 years, 20 years, even going back 30 years, U.S. stocks have outperformed. It's very easy for us to suffer from what we call home country bias. Home country bias is when you do your banking at TD, you shop at Dollarama, you maybe eat at Swiss Chalet, so you fall in love with the companies that you shop at and you buy their stocks. And that's fine. But you know what? In our opinion, there's only a limited number of good quality companies to buy in Canada. David mentioned that we've avoided oil and gas. I mentioned that we don't like to buy price taker companies. So for the most part, the best companies that we've been finding, the non-capital intensive price maker companies, are in the US. Remember when I said that stock prices eventually follow earnings? Well, here's a lot of stuff going on the chart, but you can see the earnings of US companies over the past 15 years have outperformed every other country's earnings. And like I said, if earnings keep on growing, stock prices rise, so it makes sense that the US stock market has been outperforming. You may have heard today that Apple reported record earnings, Facebook reported record earnings, Microsoft the other day, record earnings. So it's pretty clear why the US stocks are outperforming. It's due to these asset-light technology companies. And guess what? You own a lot of them in your portfolio, and we have for a long time. So we know where to catch the fish. We know what type of fish we want to catch. I know it's getting old. Okay. However, what equipment do we need to find these fish? I'm going to walk you through. Here's our equipment checklist that we use to find the fish. Number one, we look for companies that have moats around their business. A moat is what we call a competitive advantage that is both sustainable and growing. Number two, we want to find companies that have tailwinds or long runways of growth. We're looking for companies that can sell a product and service, not just in Toronto, not just in Canada, but globally, right? Think about Facebook or Microsoft. Facebook announced today that they have 2.2 billion users. That's a global company. Number three, we look for companies that, where the management owns a lot of stock. We call that skin in the game. We want the managers to, if the stock price goes down, we want them to feel the pain as much as we do when the stock prices fall. We find that very important. Number four is capital allocation. We're looking for companies that allocate the cash flow that the company earns properly. We want companies where the management is thoughtful about whether they pay a dividend, when they buy back stock, when they make acquisitions. And finally, valuation. Valuation is important, and we want to make sure that we pay a reasonable valuation when we buy stocks for you. We've learned time and time again that it's much better, far better for us to pay a higher price or a higher valuation for a wonderful company instead of buying a cheap company at where the business may be in decline. We don't want to keep making that mistake. So once we've made the investments for you, we hold and we monitor. We all know that timing the market is impossible. This year, many stocks are up 20, 30%, and if you look at what's going on in the world, as Scott pointed out, recession fears, trade wars, Brexit, you name it, how in the world can the stock market be up, right? So if you think you can time the market, that trading works for you, good luck, because in this scenario here, you're only going to be right in 1 out of the 4 cases. So our approach is we feel we're better off buying our clients a basket of high-quality companies and making adjustments to them when appropriate. We know we don't get every investment right, and there's going to be a number of names in your portfolio that drive you crazy and drive us crazy, but you know what? More often than not, we're going to get a number of them right, and we're going to be well rewarded if we use the right equipment and we are patient. So let's look at some of the fish we've caught. Every year, my wife allows me to go on what we call an NFL football boys weekend. We love football, and every year, 2 buddies and I fly to a different American city to watch an NFL football game. This year's trip was a little bit indulgent. We went to London, England to see the Tampa Bay Buccaneers take on the Carolina Panthers. It was actually a terrible game. But what I was excited about, what was so interesting, is there were fans that had flown in from all around the world. You wouldn't believe it. We met people in London from Germany, they flew in from France, they flew in from Scotland, there were people from Poland, the United States. And so this is what we call experiential consumerism. Experiential consumerism is when people spend money to see their favorite sport, to go to a concert, to go to an event, to art, food, you name it. And guess what? There's growing middle-class populations around the world. We think leisure travel is just set to explode. Let's talk about China for a moment. Right now, 10% of the Chinese population has a passport. That compares to about 40% in North America. Just imagine if another 10% of the Chinese population gets a passport. We don't have enough airports. We don't have enough airplanes. We don't have enough hotels to meet the demand. And guess what? I didn't even mention India. India has one of the fastest growing economies and one of the youngest populations. We think experiential consumerism is a good place to invest your money. Many of you might be thinking about going to Disney World this year, taking your kids or your grandkids. Take a look. It's not getting any cheaper. This is a perfect example of a price maker. Every year, Disney raises the price of the tickets. And don't even think about going without having a fast pass. The fast pass will cost you double, but it's well worth it unless you like waiting 3 hours to get on each ride. We are trying to invest your money in companies that make luxury goods and luxury experiences. Many of you have seen companies like Ferrari in your portfolios or Live Nation. We think the spending as populations around the globe get wealthier is going to continue to go higher. I want to talk about another theme that we've been investing for you for many years, and that's big technology. You've seen in your portfolios Microsoft, you've seen Google, you've seen Apple, you've seen Facebook, you've seen Visa for many years, and we always got phone calls and questions from clients, how come you didn't own the big one, the one that's growing the fastest, Amazon? Well, we finally bought it, and here's why. Amazon isn't a technology company. Amazon's market is consumption of all kinds. The little dots here are Amazon's market share in a number of addressable markets that it is participating in, whether it's advertising, retail, IT spending. These are addressable markets in the trillions of dollars, and Amazon is just getting started. And of course, it's not just in the US or Canada, it's global. So if Amazon gets it right, and I'm sorry you missed it a few years ago, we don't think we've missed anything going forward. Amazon is spending, as you may have heard, a lot of money on one-day delivery for its Prime members. By early next year, Amazon believes that it'll be able to deliver most of its products to its customers, Prime members in the US, within 24 hours. This is unbelievable. And within another year from then, Amazon is hoping to get one-day delivery across the globe. And guess what? People love it. Online spending for Amazon was up 25% year over year. People love online shopping, and we think it's a great theme to be invested in. So that's Amazon. So far I've mentioned two themes for investing your money: experiential consumerism and big technology. Now I'm going to introduce you to a new investment, the world of low interest rates. If low interest rates are really here to stay, many investors are going to have a hard time achieving a reasonable return on their money. In a low interest rate environment, we believe investors will have no choice but to put their cash to work, as David pointed out, into stocks, maybe real estate, maybe private equity, or alternative investments. Three winners, in our opinion, in the low interest rate revolution are Brookfield Asset Management, BlackRock, and Moody's. Brookfield Asset Management is one of the leading companies investing in real assets such as toll roads, real estate, as well as managing money for big institutional clients. Long-term clients of ours may have seen Brookfield Asset Management or Brookfield Infrastructure Partners in their portfolio for many, many years. I'm pleased to say that both companies hit an all-time high today. Brookfield Asset Management closed at around $73 a share. We have some clients hopefully here tonight that have owned Brookfield Asset Management going back 20 years and have a cost base of about $6 a share. So that means they've made about 12 times their money in under 20 years. We think that Brookfield Asset Management is going to continue to grow, and here's why. Brookfield Asset Management, as I mentioned, manages real investments, toll roads, real estate, and they do that for large institutional clients. They believe by 2030, over 40% of institutions at least will have, all institutions will have at least 40% of their investments in real assets. And guess what? Brookfield has the track record, they have the experience, and they have the scale to deliver these great results to its customers. Another company that we think is going to benefit in the low interest rate environment is BlackRock. BlackRock is the world's largest asset manager. Scott put a slide up showing Baskin's managing about $1.3 billion. BlackRock is managing $6.9 trillion, so just a little bit bigger, and taking in about $300 billion of assets a year. As investors look to increase their returns they may gravitate to the types of products that BlackRock offers. We don't think we've missed anything with BlackRock. There's over $200 trillion right now invested around the world in equities and bonds and derivatives. And out of that $200 trillion, only 2.5% is invested in the type of products that BlackRock manages. BlackRock and Baskin believes that BlackRock will be able to double its asset base within 5 years. A final company that we're buying and we've been holding for you that would benefit from low interest rates is Moody's. So Moody's is a company, is a credit rating agency. And as interest rates continue to go lower, governments and companies around the world will look to not only refinance current bonds that they have at much lower rates, but also take advantage and issue new bonds at very low interest rates. Over the next few years, as you can see on this slide, there's over $6 trillion of bonds around the globe that have to be refinanced. Large institutions, institutional investors will not buy a bond unless it has a credit rating seal of approval from Moody's. And Moody's has only one real competitor. So I may have said to you guys that the best fish are found in the US, but we've been finding a couple of companies in Canada, so we want to talk about Canada because there's some good fishing there. And we want to introduce you, before we finish off, to 2 Canadian companies that have long runways of growth outside Canada. Okay, I want to introduce you to this guy. His name is Mark Leonard, and he's the president of Constellation Software. He and his beard have turned a $25 million investment into a $20 billion plus company. And he's done this in less than 15 years. I can't do the math on that, but I think that's like a 10,000% return. Leonard had a unique insight 15 years ago. Most software companies charge you an upfront fee or an annual fee to use their software. Leonard's insight was, why not take the cash that your customers pay you for the software and use it to reinvest and buy software companies, and then use the upfront cash from the software companies that you acquire to buy more companies, and so on and so on. So within 15 years, Leonard and Constellation have acquired over 600 software companies. And we think Constellation is just getting started. Constellation maintains a database of over 40,000 software companies that it may acquire one day in the future. Epic beard, epic stock price. Our final company that we're going to talk about is Parkland Fuel. You may have been in one of their stores. They have gas stations on the run is what they manage. So over the last 5 years, Parkland has grown to become the largest independent retailer and distributor of fuel in Canada. My wife, Cheryl, has single-handedly been trying to boost Parkland's stock price for you. She drives our son to basketball practice out in Ajax at least 3 times a week. Our thesis on Parkland is pretty simple. Now it is the largest independent player in Canada, and now Parkland has set its sights on the US. The US fuel market is at least 10 times bigger than the Canadian market. And if Parkland is able to translate the success that it's had in Canada into the US, then we're just in the early innings of success here. So that's it for me. Thank you for joining me on our fishing trip. And I'm going to give it back to David for some closing remarks.